the secret inside their heads. How successful investors really think. Imagine two people staring at the exact same stock chart. One sees chaos, a jagged line of fear and greed. The other sees a story, a pattern, an opportunity waiting to unfold. Same numbers, same market, completely different outcomes. What separates the investor who builds generational wealth from the one who loses sleep and money in equal measure isn't luck or even intelligence. It's the way they think. Here are 5 mental habits that set successful investors apart. 1. They think in probabilities, not certainties. Successful investors never ask, "Will this work?" They ask, "What are the odds this works, and what happens if it doesn't?" This shift changes everything. Instead of chasing a guaranteed win, which doesn't exist in markets, they weigh risk against reward and size their bets accordingly. A trade with a 70% chance of a small gain and a 30% chance of a small loss can still be a bad idea if the math doesn't add up. Thinking in probabilities keeps ego out of the decision and lets the numbers lead. 2. They are obsessed with risk. Before reward, beginners ask, "How much can I make?" Veterans ask, "How much can I lose?" This isn't pessimism, it's survival. Warren Buffett's famous rule, "Never lose money," isn't about avoiding every loss. It's about protecting capital so you stay in the game long enough to compound your wins. Successful investors calculate their downside before they ever calculate their upside, because one catastrophic loss can erase years of careful gains. Number 3. They treat emotions as data, not directions. Fear and euphoria are the two forces that wreck most portfolios. Smart investors don't pretend they don't feel these emotions. They notice them and use them as warning signs. If everyone around them is euphoric, they get cautious. If panic is spreading, they look for opportunity. They've trained themselves to separate what they feel from what they do, following a plan built in calm moments rather than reacting in stressful ones. 4. They play the long game on purpose. While others chase quick wins, successful investors think in years and decades, not days and weeks. This patience isn't passive, it's a deliberate strategy. Compounding rewards time above almost everything else, and short-term noise, a bad quarter, a scary headline, rarely changes the long-term trajectory of a sound investment. They ask, "Will this matter in 10 years?" rather than, "Will this matter tomorrow?" 5. They study their mistakes. Like a scientist, every failed investment is treated as a lesson, not a tragedy. Rather than blaming the market or bad luck, successful investors dissect what went wrong. Was the analysis flawed? Did emotions override the plan? Was the risk miscalculated? This habit of honest self-review turns losses into a personal education that no book or course can fully replace. And it's often the single biggest reason experienced investors keep getting better. None of these habits require a finance degree or insider information. They require discipline, self-awareness, and the willingness to think differently than the crowd. That, more than any secret formula, is what truly separates the investors who thrive from those who merely hope.